name is Ben Marks, and today I'm doing a reval on JWA, which is John Wiley & Sons, which is a publishing company going towards the digital side. So from here you see that the price target's in between 68.57 and 70.8. That's technically a 7% increase, but their fiscal year ends in September, so that's half the year, so that's actually a 14% increase. Just to give you a little overview of what I'm going to take you through, I'll show you how we came to own this stock, as well as go through the operations, through having some management changeover, go over some key statistics, as well as the digital trends, and so on. So jumping right into it, how we got here is that about 2 years ago, we had a pitch to buy an undervalued asset in the publishing industry. Publishing at the time was trading at a 12.5 PE versus now it's at around 20. And overall, all of these companies were getting lots of revisions because publishing was seen as going to be obsolete. So after seeing this, we saw that it was actually a very good investment because not only that, we were seeing a lot of investments into digital side, as well as strong dividend growth in order to maintain current cash flows. So to date, we actually have a 68% return from a year and a half ago, and currently it closed today at $65. So we actually exceeded the price target originally anticipated, which was actually a 3 to 5 year price target rather than a 2-year price target. So just to give you some background into the company, just a little brand name recognition. They actually own the For Dummies series, so you might have heard of them through that, as well as John Wiley's son owns an online library where they keep all their research, which is their largest industry, all their journal articles, books for scholars and professors and professionals to get this information. As well as this is their publishing company, and this is for their professional development. In terms of, these are 2 societies which they do publishing for. That's 2 of 800 societies where the top 10% of revenue comes from the top 20 societies, so it's very diversified in that area, as well as some of the research agreements that they have, which are with Hinera, which gives research to individuals in schools and such in Africa, as well as these other ones. So it shows that their operations are all over the place, and they're very expansive as a company. So just in terms of the 3 different areas, we have research, which makes up 56% of the company. And as I said, they publish for 800 societies, which makes up 60% of that 56%. So about 25% of the overall revenue comes from the publishing side. Then we have higher education, which is one of their growth areas, which is very much based on moving towards the digital end in order to help increase revenue for that side. That comes from lots of textbooks for students in both Europe and the US, as well as they're trying to advance that into the digital end for digital books as well. And then we have professional development, which is largely grown through their acquisitions, and they have made around 8 acquisitions in the last 3 years, but they've been very small companies, and they've been growing them organically from there. So it's a lot of inorganic growth at a very early age, and organically growing them from there. So just to put in perspective, Wiley Plus was they started in 2010, and Deltec was acquired in 2012. And currently that makes up 32% of professional development, which is 20% of the overall company's revenue. So a lot of it's coming from acquisitions as well. So that's a key part of the company. So just to go into the company breakdown for you to better understand it, this is the breakdown of the company as mentioned before. And from the financial model, these are the calculated growth rates just based off of the last 5 years information. So what we saw is that research, while being 56% of the company, it's actually growing very slow. So we're not seeing as much growth rate there. And they're kind of requiring the other 44% in order to maintain the growth of the company. So they're spinning off a lot of old underperforming assets in those areas and trying to build it up through these acquisitions in order to maintain higher growth. That's actually seemed to have worked for higher education. Unfortunately, professional and trade, seeing they're divesting a lot because they have to do a lot of restructuring, and they have around $60 million in restructuring in the last year alone, and which is mainly targeted towards the professional and trade area to make it more profitable. So just looking year over year, it's clearly doing better. So to average it out, I took the 3.6 from there, considering that's going to be where they're pulling growth. But ultimately, digital and print is where they're trying to make the biggest growth. And that is where they believe that they can maintain high returns on investments. Another thing to worry about for the company is necessarily the management changeover. I'm not saying it's a bad thing, but it gives you a lot of uncertainty. So you're looking at the four major positions in the company. You have the chairman of the board, who is retiring in 6 months. You have the CEO, who will be out on medical leave for at least 3 to 6 months due to urological cancer. It's a recurrence which, according to my research from American Society of Cancer, is actually a much worse version than finding it initially. So that's around 6 months of not having a CEO. And then the CFO is their only person of the main 4 people of the company that's going to stay put. But the CEO is now the interim CEO, but he was just promoted 2 weeks ago to CFO. So you're having not necessarily an untrained individual, but somebody who just got promoted to CEO, who has yet to be in the C-suite but operating with them, is now the head of the company. So it leaves some uncertainty. I'm not saying it's a bad thing, it's just something to question when you're thinking about risk versus reward. Then we look into the company statistics. I highlighted some good factors and some not so good factors. Ultimately, they actually are top 3 in the area for best gross margin and best operating margin, which is very good for a publishing company, and that's highlighted through their switch towards digital. That said, digital is actually not as big of a part of the company as they would like, but we're still seeing 72% of gross margin compared to 54% for the industry average. So. And then some other things are that the PE is relatively high, as well as some general metrics of price to sales compared to the industry average. And an interesting thing to note, considering that a lot of their growth stems on investments in acquisitions, if you look at the return on capital and return on equity, you're actually seeing a decline in return on invested income. So, despite putting all this money into these things and growing them organically, it's going to take time in order for them to see this growth to fruition. So going into the digital trend, as I mentioned before, digital is where you see the higher gross margins, because selling a digital book for the same price as a print book is exceedingly beneficial for them. That said, these are the different sectors, as well as the total of all of these, and we see a decline in research. Higher education is only it's marginally getting better for digital sales for books at best, as well as professional and trade being the largest gainer. That said, that is 32, 38, 25, 32 million out of an average of $450 million a quarter. So it's still not a large portion of the revenue stream, which it's not that they're not making a push for it, but the demand for print books is still too high. So it's not so much that they could force a trend onto the consumers, and that is the biggest issue. So when we're thinking about, yes, they do have this great opportunity of digital trend. It's only so much. One, it will somewhat capitalize the print book, and ultimately, what we see, especially in higher education, is that it's more of a in tandem, if anything. You typically go for the print book plus the digital rather than just the digital, or it's either that or just the print itself. So, while it does seem beneficial, it isn't necessarily the best driver for a publishing company to keep in mind. Just for some more comparables, it's important to note that just from the gigs on Bloomberg, the average price to earnings for the area is a 25.9, which is very high for publishing. Looking at NYU's research, they said that the forward PE would be around 24.6 for the next 5 years, so sort of maybe a topping out, if anything, for that. But it's sort of high prices, especially to the earnings of publishing companies. While, because there isn't as much growth as other areas that you see these high PEs at. But looking into specific metrics, for a lot of them, John Wiley and Son are actually worse than competitors, especially for why we got into it. The dividend is actually lower than the average, and it's actually most likely dropping lower considering due to the price increase of the company and the lack of increasing the dividend. So it's actually sitting around a 1.2 now rather than the 1.6 figure. Even if they did increase it by the 15% annual increase that they typically do, it would be at a 1.4. So it's looking as if the dividend's not going to keep us maintaining that level. And its price to sales and price to book are much higher, as well as its debt to asset leverage is actually higher than other companies in the area. And there is some good news for the company, as it does do better in both operating margin and gross margin. So it is how you more so want to play it. If yes, they're technically making more per sale, but ultimately there are some factors that are saying that it might be a good time to exit the position. So performance versus the ETF is a big thing, because if we were to sell the company, it would go to the ETF, which is in the consumer discretionary. And this is since the oil peaked. This is a chart graphing the oil peak, which was like at $110 a barrel. So what we see here is that the index actually, from this period, has outperformed both the S&P 500 and JWA as a company. And this sort of makes sense because a lot of consumer discretionary is shipping based because it's discretionary spending. So they have to get these goods to different areas. For publishing, while it is a big factor of shipping books, you're seeing that less and less with the digital trend as well. So it's, yes, it's some counteracting there, but you're also having you have more publishing areas in other areas as well. So this way, it's not as much shipping goods. So I personally think that the ETF is a safer investment. Going into the valuation, just doing the discounted growth model, using the 3.21% growth rate, I got a 70.85, and then using the higher growth rate, which was depending on the weighted averages of the areas of growth, I got a 73.4. So that's right around the area where I think the target price would be. And then my ultimate recommendation would be that we should exit this position for the sheer fact that while, yes, we're leaving some growth on the table, there is a lot of risk that comes with this growth opportunity. So it might be safer to be in an ETF that is more diversified and shows equal, if not better, growth margins So ultimately, because of the low growth and the high valuation, I'd say that it's a good time to exit the position. And with that, I'll take your questions.
We have about 15 minutes for discussion.